Hey guys, how's it going? And thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money because you know schools aren't. Don't forget to subscribe, so let's get started. So in this video, we're going over ETFs that we could look into for 2019. The top ETFs out there that we should definitely look into. We got a lot to go on, so let's go. Starting off with the first ETF is, of course, the most obvious, an index fund. So, this is Vanguard S&P 500 ETF. This is VOO. Another similar is SPY, that's Spiders ETF. But this has a little bit less of an expense ratio of 0.04. Most ETFs have low expense ratios, so that's a great thing. So you can see their 5-year chart. Their yield is around 1.8%. So this one has all the great things that a normal index fund or index like mutual fund would have. Basically has every company out there. So it's super simple, great investment. I would suggest it for anyone. Now we could look at the history. This is for the other ETF of SPY, but we could look at the performance for past years. So we could see all the way back to 2000 and up to 2017. So we could see a bunch of drops in 2000. That was the tech bubble. And of course the last recession of 2008. So we're going to kind of be comparing these performances to other ETF performances as well. The second ETF that we're looking into, which is my personal favorite growing into this like bearish, uncertain type of environment, it's just high yield. So this is another Vanguard high dividend yield ETF. This is VYM. So again, low expense ratios. You can see the 5-year chart, and the yield is around 3%. So we could see why their yield is 3% because of their holdings. So we could see a lot of the top dogs and a bunch of high dividend payers. My personal favorite, Johnson & Johnson. They have JP Morgan, Exxon, Pfizer, Verizon, and a bunch of other players. Now this ETF doesn't have a huge history, but it does have something. So we could look at that going back to 2007. We could see that they dropped by around 32% in 2008. Now if we look back at the SPY, it dropped by around 37. So it dropped a little bit less than the overall index. So that's good, and also has good amount of dividends, keeping you happy during down times. Moving on to the third ETF. For you growth guys out there, don't worry, I got you. Just understand this is a little bit more volatile. As we've seen in previous months, things go up quick. They could also go down just as quick. And this is exactly that going into the QQQ ETF. You can buy this. This is basically all tech stocks. You can see their 5-year chart and recent decline toward the end of the chart. Their dividend is much less because they're just purely growth of around 7.8%. Most of us know these top dogs, but just let's look at them real quick. Of course, the top guys are Apple, Microsoft, Amazon, Google, Facebook, and those other guys. Now, it's good to have that growth in there. Understand there is a lot of risk and a lot of volatility during bear markets. We see that a lot of these players are actually down around 20% right now. So if it goes even lower, they're going to get hit even more. However, also understand when you're buying at a low point, if you're looking at 5, 10 plus years, they're at a low point, so when they rebound, you can make good money on them. So just have that long-term perspective in mind. Moving on to more growth, just understand it could go up quick, it could go down quick. However, for the long term, these types of funds tend to outperform the just overall market like an index fund. So this is Vanguard Small Cap ETF. You can see their 5-year chart has nice growth. However, recent months, really bad. Their yield is around 1.5. Looking at small cap performances, like in 2008, dropped just as much as the market. In some circumstances, it could drop even more. However, during the rebound and the growth process after that drop, it grows even faster than the overall market. So in 2009, it grew at 36%. At 2010, it grew at around 28%. So it can definitely grow faster than the overall economy because they are smaller companies. They could grow faster. Okay, now slowing down a little bit, moving away from growth. I mean, there's still growth in there, don't you worry. But it's a little bit more on the safe side, going back to the dividend aspect. So the next ETF we're talking about is sticking with Vanguard because they have low expense ratios. You're welcome. This is Vanguard Dividend Appreciation ETF. You can see their 5-year has been actually, for a few years they've been fairly steady, but it is definite constant growth. You can see their yield is around 1.8, pushing 1.9. Some of the holdings that they have is Microsoft, Walmart, Johnson & Johnson, PepsiCo, McDonald's. So these have nice dividends, but they also have some growth behind them. So it's kind of like a mix. And going into that bear market situation, that's kind of what you like. You know, you still want that growth because when a market rebounds, you want it to rebound just as quick. So, you know, you want those dividends to make you happy during down times, but you also want to get that quick growth afterwards too. So you can see their history in 2008, it did drop less than the market, dropped around 26.5, and it still is returning nice amounts in previous years as well. Now the next and final ETF that we're going over today is, if you like dividends, this is for you. Understand that this is a complete diversification away from stocks and moving into real estate. I mentioned this a couple different times throughout my other videos, but it is good for dividends. It's good for diversification of your portfolio. Just understand it has other risks and aspects to it. Moving on to Vanguard Real Estate ETF. Interesting. So this is their max chart. And you could obviously see that drop in 2008 because that was involving real estate. But you did see that rebound, and over the past few years, it has some decent growth. Last couple of years is kind of steady, but it does have a very nice yield of over 4%. Now real quick, this did so horribly because it was involving real estate in 2008, and this is investing in real estate. Now the next recession or bear market or whatever is going to happen isn't necessarily going to be related to real estate. So in previous recessions or previous crashes, when the stock market was dropping, real estate could be doing something completely different. So this is why I would kind of suggest another diversification strategy. You can see their performance, of course, 07, 08, horrible, but in other years, especially years right after, it has decent rebounding and continuing growth, as well as that very nice dividend yield of over 4%. And that's all I got, guys. So I would definitely recommend to diversify around multiple, if you're interested in ETFs like this video went over, get multiple ETFs. If you're into stocks, get multiple different stocks. Don't just all growth or all dividends. I think a good variety could definitely help you benefit yourself. So, you know, I like that growth, you know, with those tech stocks and with other types of investments. But I do like that growth combining dividend growth as well. So that's why I suggested some of those dividend ETFs that could definitely help you out during down times. The number one rule of money is not losing it, because a lot of people don't understand that when you lose money, it's actually much harder to gain that back. So if you lose like 50% of your money and you gain 50%, you're not even back to where you started. If you drop by 50, you have to get 100% return to get back to where you even started. So that's why I don't want to lose as much money as possible. You know, these growth stocks, they're great with growth, but you're going to lose a lot there too. So I threw some out there for you guys. These are like the simplest ones basically. There are a bunch out there, of course, so do your research, but let me know what you guys think. If you have any questions, comments, concerns, please leave them down below if you have a favorite ETF. But thank you so much for watching, guys, and I'll see ya in the next one.